I am joined by Kyrill Asatur, founder and CEO of Centerfin. Kyrill, great to have you on Forward Guidance.
Thank you so much for having me, Jack.
It's great to have you here, Kyrill. You know, a lot of the folks who I interview, they think the dollar is going to implode. They think it's going to explode. Interest rates are going to the moon or they're going negative. They have a firm, conviction that's sort of based on it. But you are actually managing real money. You're an investment advisor, and So tell us a little bit about Centerfin and what role macro plays into that.
Yeah, absolutely. It's a great question, and macro is ever so more important today than it has been in recent past. So about Centerfin, so we started Centerfin about 2 years ago and went live with it about at the beginning of this year. We manage money on behalf of individuals. We are a registered investment advisor. We manage money with a long-term view, but we take into effect a kind of a global macro view in helping us with our asset allocation. And so we're not an automated advisor. We're not a passive, investing platform. We are really utilizing decades of experience in the hedge fund industry and the relationships that experience has brought to the team to help inform, how to position clients in this very unprecedented market environment. And so, as a great example of how this kind of reflected itself recently, at the end of last year, as you recall, everybody on the sell side and the Federal Reserve was talking about how the inflation that we were witnessing in 2021 was likely to be transitory. We had formed a view and kind of talking to a lot of our network that, there's a decent probability that inflation was going to be not transitory and was going to stick around a little bit longer and be, more of a problem than what was being spoken about at the time. And so what we sat down to think about is, what is the obvious thing to do for clients if you think inflation is going to be more of an issue than what is being priced in the markets right now. And one of the most obvious things to do is really just, limit exposure to any traditional fixed income assets. Because if you think about the way that inflation works, real interest rates on fixed income assets become negative, and hence they're uneconomic to hold, and hence it's not a good place to be. And so what we've seen in the first quarter and continue it throughout 2022, as the narrative around inflation and the data has been obviously more than transitory, we've seen fixed income assets fall in price as yields have gone up, and that's a good example of how we use our macro views. So it wouldn't be offensively, so to speak. It would be more defensively.
Yeah, that's a great example, Kyrill. And when you make a sale, how do you decide about what to do with that cash? Because an individual investor who is, feast or famine by their own dint, by their own investment choices, if they want to sell the S&P 500 because they get scared, if the S&P crashes, they feel good, they feel smart. If it doesn't and they lose out on a rally, they have no one to blame but themselves. But if you do that, Kyrill, a client can say, hey, Kyrill, you lost, the S&P 500 went up 20% and we were in cash. So what happened? So how do you deal with that?
Yeah, so it's actually very relevant to the conversation we're having, exactly today in kind of mid 2022, because we're kind of sitting in a place where it's not clear that the market has found a bottom at this point. But we are also managing money on a 10, 20, and 30-year time horizon, right? And so that's the balance of trying to figure out, how do you position clients to mitigate that drawdown while maintaining that long-term mindset. And so what we do is we kind of shift things around in the portfolio. And so, at the end of last year, to your question about what do you do with the cash once you sell the fixed income exposure? Well, we came into this year with a heavy allocation to commodities, precious and base metals, some natural resources, although we were clearly underweight energy, and we kind of fixed that during the first quarter. But that's how we approached it, because we felt like, what is the beneficiary of inflation? It's obviously commodities is the obvious place to be.
And what have you made of the huge run up in commodities, and to what degree do you think it might be halted, given that we've had some very jittery price action over the past month, particularly in things like copper, iron, and natural gas?
Yeah, it's a great point. And this is where I think the balance of the kind of short-term market moves and the longer-term perspective comes in. So, commodities did behave as expected kind of in the first quarter. But as you know, everything kind of rolled in the second quarter, everything kind of rolled over as we started to see recession and growth fears. And so, all of the commodities have now come down because, the market's more focused on potential recession hitting us than it is on inflation, right? And this was, we were kind of witnessing this throughout the second quarter and discussing it internally. And the underlying fundamentals for commodities, right? So copper, gold, not so much, but let's say copper as an example. There is a fundamental supply-demand imbalance, given that we are moving globally into this, electric vehicle and electricity as a source of energy for vehicles. You need a lot of these input commodities to make that happen. And so long term, there's a very bullish fundamental picture for commodities, almost all commodities at this point. And so our view has been, while they've rolled over, we've maintained our existing exposure at this point anyway, and we think long term, fundamentally the picture is very bullish for commodities.
And let's say a client says, I really want to be allocated towards commodities. Are you then investing in sort of hedge funds that buy commodity stocks? Are you buying commodity stocks yourself? Are you owning ETFs that have futures positions? Give us the range of sort of how you do commodity investing.
Yeah, no, it's a great question. So it's a mix of all the above, with the exception of, at least yet, hedge funds today. So right now we express our views via ETFs that either trade the futures as a physical, as well as commodity equities. Right, commodity equities actually. Our CIO and I, we discuss this on a regular basis. There's actually some benefit to owning the commodity equities if you're bullish on the underlying commodity. And so we have a mix of the two currently.
Right. And so I know we were speaking earlier, you have a certain view, your chief investment officer has a different view. To what degree do those views get implemented in client portfolios? Is it in the basis points of we're going to up the copper allocation from 76 basis points to 77 basis points because Kyrill is feeling pretty bullish on the long-term electric vehicle story? Or is it more significant than that?
No, yeah, it's great to have kind of a healthy debate. We don't again, given our experience, our CIO has spent a lot of time in the hedge fund industry, myself as well. Having kind of different biases, and I do tend to have a more bearish overall bias, while our CIO I think has a bullish overall bias. I think that's very, very healthy because it helps us balance the exposure in client portfolios, and it is on the margin, right? It's going to lead us not to make any big bold calls, because that's not what clients are paying us for, right? We are not a hedge fund. We're really trying to manage their money on a very long-term time horizon. But we do think it's very important to be tactical in this market environment. And so this internal debate kind of helps shape how we tweak things along the way. And we have been doing that for the last year or so, and we'll continue to do that. We were just on a call with a very well-regarded technical strategist just before this call, kind of discussing kind of more short to medium term technical views to help us inform, some of the things we've been talking about doing for client portfolios.
Right. So you said you have a bearish bias. How are you thinking about it now in terms of the Fed, in terms of inflation, as well as other macro drivers of risk assets, namely, let's say, the S&P 500?
Yeah. So my personal bias, I think, has always been, somewhat of a glass half empty type person. And so I generally, and I know this about myself, I generally do tend to get caught up in, what's referred to as macro bear porn, right? I mean, it's you read about some of these stories and they make sense, and they convince you that the world's going to come to an end, and you should just go to cash and hide everything under your mattress and whatnot. But being cognizant of that bias is important. And so my bias to being bearish and the current thinking is largely due to the fact that in the kind of medium term, I think we've seen a pullback from what was a very monetary environment, liquidity-driven market move that predated COVID, but then got exacerbated by COVID. Right? I wrote about this in our quarterly letter. If you take a step back, post financial crisis, we've been in this loose monetary environment for a very long amount of time where inflation has been under control. And so the Federal Reserve, kind of every time stocks pulled back or there was weakness in the economy, they just basically did more of what they were doing before, which was providing easing into the monetary in their monetary policy. And so but that'll change at the beginning of this year, right? So inflation, proved to be, as we were talking about before, less than transitory. The Federal Reserve has a dual mandate, and that's maximum employment and price stability. The maximum employment mandate, based on last Friday's jobs number, is doing just fine. But that price stability mandate is out of control, and so lots of folks are talking about how the Federal Reserve is going to pause because there is a recession coming, but until they see it in the jobs numbers, it's hard to see how they pause because inflation is high and maybe it's peaking, but on an absolute level, inflation remains too high, and I think the Fed is going to continue to hike to bring that down. There was an article yesterday in the Wall Street Journal by somebody who seems to be somebody that the Fed uses to kind of get their views out. He was the one who broke the scoop that the June hike might be 75 bips instead of 50 bips, which was priced in, the week before their meeting. And he wrote about how the Fed and Jay Powell is hyper-focused on not repeating the mistakes of the early 1970s, where the Federal Reserve under Arthur Burns, they hiked, and then there was a recession fear, so they eased, and then inflation, continued to be a problem until Volcker came around and really got inflation under control.
Yeah. So, Kyrill, over the past decade, really 14 years, where we've had ultra accommodative monetary policy, anytime the S&P 500 dipped down something like 20%, the Fed was the first at the scene with the bandages, with the ambulance, and that was called the Fed put. And so shrewd investment advisors, perhaps, if this is backward looking, of course, but anytime the S&P 500 was down 20%, they would back up the truck to buy as much as they possibly could for their clients. Well, we are over 20% down in the S&P 500 now, and it's quite clear that the ambulance is not coming. So my question for you is, at what point do you think the Fed put is coming? I guess you could, you could, instead of saying on the S&P 500 a rough level, you could say a high yield credit spread or some other level of the dollar, or any other macro indicator you want. What is going to be the siren song that brings the ambulance? And also, would make you want to back up the truck for your clients and just sort of have you draw your line in the sand? Because my sense now is you have not drawn your line in the sand now. You're open to more declines. That's my sense.
Yeah, I think so. And I mean, the concern is that, the more we talk to people in the know, the more that seems to be consensus, which is always kind of concerning. But like somebody just recently that I was talking to said, you can't just be bullish because everybody's bearish, which is true, because I do think we need to adjust for a new monetary regime. And to your point about the Fed is focused on inflation. They're no longer focused on, again, the jobs picture remains pretty strong, and so they can't. That part of their mandate is fine, and inflation is not fine. And so I think that we need to mentally adjust away from this buy the dip mentality and really think through, the second and third order effects of what this Fed policy means. And I think where we'll see it and where the potential for the Fed to pause is not going to be with the S&P 500 at a certain level. It's going to be with something breaking in the credit markets. And so once you see cracks in the credit markets, which you've seen spreads blow out just recently, just in the last quarter, but they're not outrageous at this point. It's not. There's nothing broken right now, right? I mean, there's not a lot of capital markets activity because companies are not expecting to be financed in this market environment. But nothing seems to have been broken yet. I think once you see some cracks in the credit markets, that's probably where the Fed starts to get focused on whether or not they're too tight and maybe pausing or going the other way.
Interesting. So it would be in the credit markets, not the equity markets, that would cause a Powell put, a Fed put. Kyrill, what is your view on how much Fed policy actually works? Like, how sensitive do you think GDP and inflation actually is to the shrinking of the balance sheet or the raising of interest rates? And also, is it sort of a real effect, or is it kind of a narrative effect?
That's a great question. I don't think I have a super smart answer, except that, if you look at history as a guide, you did see, the effect of monetary policy flow through to the real economy, right? And so, the Federal Reserve at the end of the global financial crisis, they did things that were unprecedented at the time, quantitative easing, which, is now something that we've come to accept. If you recall, that is something that was supposed to be temporary. It was supposed to be a temporary measure. It became, it just became something that was, common for, 12, 13, 14 years. And I think that has led to asset prices being higher. And I think the economy is kind of trounced along the whole time. As long as the economy has not been in a recession and the jobs picture has been healthy, the Fed has been, very happy with their policy. But I think, again, not to beat a dead horse, but I think we're living in a different environment where we do have an inflation problem that we haven't seen since the 1970s. And the Fed has to act differently. And I do think, yes, it does have an effect of slowing down the economy because whenever you tighten monetary conditions, it's going to feed through to the real economy and slow down the economy. And we're already seeing some of this, right? Like, you've seen economic data, except for the jobs number, get fairly weak in the latter part of the second quarter. So I do think that there's a correlation to Fed policy and the real economy. But I worry about, the Fed is not worried about, I think, stock prices, which is what I think people came to believe in the prior QE period. If anything, I would say, again, at a very high level, I think that has grown the inequality gap, right? Because, only the top, whatever it is, 10% of households, at least in the US, own financial assets like stocks and real estate. And that policy has helped those assets grow in value. Most of the population actually does not own financial assets, right? And so I don't think that the Fed is going to be, concerned about stock prices, but I do think it does have an effect on the real economy, and they need to be cognizant of that.
Kyrill, switching gears a little bit, I know you said that you were sort of trading .com stocks in your college dorm room. Would you think that the past 2 years of speculative fervor, if I can call that, with sort of all the fresh new IPOs, the SPACs, all the companies that have no profit, no revenue, and they're trading at $10 billion, is that not comparable to the .com bubble? Is it comparable? Is it even worse? And also, what was it like sort of launching your product as that was crashing?
Yeah, it's a great question. So I think no, as they say, and it's a little overused, but no two periods are exactly the same, right? But there's similarities, and I do think there's a lot of similarities between what happened kind of post-COVID and the explosion of retail trading with platforms like Robinhood, providing an easy way for more entrants into the market, to when I was in college and E-Trade was a new thing back then, where I can open up an account online, I can trade for relatively cheap relative to history at that point. And you had all these new .com stocks that were promising to change the world, that were trading at crazy valuation multiples. So at that point, this last 2 years, you had electric vehicle stocks and other high growth tech companies that were part of the quote unquote bubble. In the late 90s, early 2000s, you had I remember internet accelerators, right? So these were companies that basically they had all these like internet companies under their belt that they incubated, and they traded at crazy valuation multiples, and they all crashed, and most of them actually, I think all of them went away. So I think there's a lot of parallels to that, and I think that we saw this clearly, when you saw this. You saw the meme stocks and stuff back in the 90s. It wasn't on Reddit. It was on the message boards on Yahoo Finance, right? Like, I mean, I was on those message boards. It's very similar. So there's a lot of parallels, and there's a lot of history rhymes, as they say, to what happened back in the late 90s. And I think it's healthy and unhealthy at the same time. It's healthy in that it helps teach people a lesson. Like, I learned a very hard lesson. It's helped inform my view over the last couple of decades as I've been working professionally in finance, and hopefully it teaches people's the younger generation today that's entering the stock market the same lessons, because I think they're valuable. It's obviously.
Sorry, Kyrill, what was that lesson that you learned?
That there's no free lunch. That's kind of the basic lesson, right? Like, there is no get rich quick scheme, right? The to the moon, memes are temporary. They're just it just doesn't happen, right? Like, this whole concept. One of the things I really respect Robinhood for everything they've done and what they've built, and having started a company, it's very difficult, but this concept of trade stocks for free is just misleading, right? There is no free lunch. There is nothing free, right? And we learned this with Facebook, a while ago, right? If it's free, you're the product. And so I think that's an important lesson, because I think, most people just thought stocks go from, up and to the right forever. And that's just not the case.
Definitely wise advice. There is no free lunch. Yeah, Robinhood, I think, really revolutionized the free trading. And to the extent that, I'm on a different brokerage platform, but I have free trading, I think that's because everyone just wanted to catch up and compete with Robinhood. Although I will say, when I try and buy a Canadian stock or a European or a Chinese stock, and I have to pay that $4.95 or something like that, I am a lot more discriminating. I pay a lot more attention.
Absolutely. No, I mean, look, I do think they did a great job in kind of, putting pressure on the brokerage industry. There's a ton of fat in, anything retail oriented and on Wall Street. That's kind of one of the reasons we started Centerfin also. And so, kudos to them for including this whole new part of the world into financial markets. But I do think there's a balance that needs to be had there.
Yeah, and tell me about Centerfin's ability to access funds that would alternatives, let's call them, that normally are not accessible to retail investors. Why was that important? And then we can get into the alternatives like distressed, macro, long, short.
Yeah, absolutely. So that was a big part of the thesis, and really to take a step back, I think when we started talking about it, we were basically just looking at the way that a lot of the institutions that we've been dealing with or working at for a couple of decades collectively manage money for the long term. They and the institutions I'm referring to are kind of endowments and pension funds and the like. They've been managing money in this way where they are including alternative assets into their asset allocation portfolio, and it's really designed to, it serves different purposes and for different institutions and depending on their portfolios. But really, it's trying to access a return stream that's not as simple as stocks and bonds, right? That's a little bit of a different return stream that's getting its the driver of returns is different, and so it creates a diversifier for the portfolio, for the overall portfolio of stocks and bonds, because that's the core portfolio, and it also provides access to sometimes asset classes that are just not in stocks and bonds, right? And so our point of view was, first of all, we have the know-how and the relationships to be able to diligence and understand between all of the managers out there who makes sense and who doesn't make sense. We have the relationships to actually access them, because I think if you were to even 5 or 6 years ago, if you were to kind of pitch what we're pitching, I don't think it would have been a very easy thing to do. But I think that in this environment and this focus on retail and the institutions actually pulling back from alternatives over the last 5 or 6 years, I think it creates an opportunity for us to come in and offer a different path for some of these hedge funds. And so we just have the know-how and the relationships to be able to diligence these managers and implement the strategies in client portfolios in a way that I don't think any other group really has that's doing something similar.
Yeah, it definitely is hard to invest in a hedge fund without a lot of money, for sure. So that's just, you're pooling the client's money. That's interesting. And then can you just walk us through the different alternatives? Because the word alternatives, it can be very confusing. So there's long short, which is like long Disney, short Netflix. Then there is distressed debt, which is actually where you came from, right? How you started. So you're buying like really off the run credit bonds that are trading at deep discounts. What else is there in the alternatives world, and why is it so important as a diversifier?
Yeah, no, we can spend hours talking about all the different types of alternatives, but to break it down into maybe kind of broad buckets, I would say, the biggest and let's just stick to hedge funds for the time being, but there's also obviously venture capital and private equity, which broadly speaking are part of alternative investing strategies. And so I think in the hedge fund space, the largest category today is equity long short. To your point, this is where a manager might be picking stocks long and short, positioning the portfolio, to be long stocks that they think are going to outperform the market and short stocks they think are going to underperform the market. And so, that's probably 60 to 70% of the market, if I remember correctly, based on the latest stats. And what that does is it designs a return. Again, if you're both long and short stocks, it designs the output of that is a return that's very different than if you were just to own stocks, right? Because when markets go down, you're not going to go down as much as the market because you're also short stocks. Hopefully, you're picking the right stocks, and when markets go up, you're actually outperforming the market, and so the overall return profile is a higher quality return than just owning stocks. And so what I've observed in my experience in the equity long short space is, the managers that I think stand out to us are sector focused managers. So these are managers that actually focus on specific sectors. So, TMT, tech, media, telecom has been, a big sector, obviously very popular over the last, 5 or 6 years. That's an interesting sector where if somebody's only focused on those stocks, that smaller universe of stocks, it's more likely that if they're good, they'll over a period of time, they'll provide decent performance above whatever the underlying benchmark is. Energy focused managers, obviously there's not a lot of those, but that's an interesting area. Financials is another, not a lot of managers in that space, but it's another interesting area. Consumer stocks, there are some managers that are focused on just consumer stocks and real estate stocks. Actually, that's kind of an interesting area where that's relatively new. But I think that's where there are managers that can actually add value. Away from equity long short, there's, to your point, distressed debt. I spent, after Goldman, I joined a fund that was run by 2X Goldman distressed debt prop investors. And that's a really interesting asset class because these are people that operate in the credit markets, really in the markets for highly levered companies. And they only really get involved when, as I mentioned before, when things break, right? So when a company that has too much leverage starts to have financial stress, the credit or the bonds or the bank debt or the loans of the company start to trade down in the market. Distressed debt investors, they step in at that point. And so what happens is that you have this very interesting dynamic, and we touched on it offline, but you have this very interesting dynamic is where you have certain firms that are their mandate is to own certain credits, right? They might have to have a certain rating, they might have to have a certain price. When that breaks, when that price breaks or that rating gets lost, they have to sell those assets, and that's when the distressed debt investors step in because they're the ones that are going to help transition the company. They're only buying into it because they think there's value, right? So if you're buying a bond at 30 cents on the dollar, you think there's more than 30 cents of value in that bond. But there's two different outcomes for that, right? You can restructure the company. If the debt is trading at 30 cents, you're probably going to restructure the company, and you're going to receive equity in the new, in the new company that comes out of the restructuring, and hopefully, the business model is sound, and that equity will trade higher with the market. The other scenario for distressed debt is liquidation, right? So if the business, if the stakeholders decide that the business is not a going concern, they're going to liquidate the assets, and hopefully the value you get for those assets is more than that 30 cents that you paid for that bond. So that's kind of distressed debt. Super interesting. Not very correlated to either credit or equity assets, which is why we think it's interesting.
Kyrill, that surprises me. That because if it's a distressed bond becomes distressed when a high yield bond sells off from 80 cents to 59 cents, right? So when as it's a falling knife from 80 to 59, high yield is not doing well. So wouldn't that correlate immediately to distressed?
Well, you have to remember the distressed investor is not owning it at 80. They step in when it comes to 60, and usually they step in when it's at 20 or 30, right? And so the high yield funds are no longer owning that asset, so they experience that first leg down. The distressed guys come in later, and that's why it's not correlated to those assets. It's really a strategy that's based on an event, and the event might be a restructuring, might be liquidation. It's not so much at the whims of the market, so to speak.
And so I imagine, those distressed type funds, very profitable during times like 2008, it's pretty profitable in 2020, although the distress did not really last long enough for people to gain a position. But what do distressed funds do when there is no distress and, credit spreads are at 2 and everything is hunky-dory?
Yeah, that's a great question. Very near and dear to my heart of a question. It is somewhat of a cyclical strategy. I think our view is that if you're a manager that has, Oaktree is a good example, right? They have tens of billions of dollars in each fund vintage. They're an amazing, long-term investor that's been around for a very long time. But when there's not stuff to do, I honestly don't know what Oaktree does when there's not a lot of stuff to do. That's why I think, our view would be to focus on managers that try to stay relatively small and focus on things that are sub the Oaktree size in terms of the investable universe, and if you do that, I think that there's a much more sustainable strategy that can, there's always something that's breaking, and so if you're not too big, you can actually successfully run that strategy even in periods of time that don't seem to be fruitful for the strategy.
Yeah, how do you think about size? Because on the one hand, you want to trend follow, right? You want to invest with someone who has done really well over the past 10 years, but someone who's done really well over the past 10 years would have like $1 billion under management, and it's a lot harder to trade with $1 billion under management than 30 million under management. So, are there certain sizes where, you won't do, if it's smaller than 30 million, we won't do it. If it's bigger than 10 billion, we'll never do it, or no?
No, I think that's a great nuanced and thoughtful question, because I think this is where our experience in the industry comes in. It's understanding, first of all, knowing the managers and having kind of firsthand knowledge. This is not, we're not like, going through rankings on Morningstar or anything like that, right? Like we know these folks. We've been in the business with them for a long time. So knowing, who are the, not only the quality investors, but who are the quality people, because at the end of the day, you're investing with people and you want to make sure that they're, super high quality individuals, and understanding what their strengths and weaknesses are. And is their fund or business set up to take advantage of whatever they're trying to take advantage of? And so I don't think there's any hard and fast rules. I think for every market and every kind of strategy, it's going to be different, but that's kind of where our history, relationships, and experience comes in helping us make those determinations and helping with that judgment.
I want to go back to the long short. So I know that because the spread between two stocks can be quite small, like long Disney and short Netflix, these players, they lever it up a lot because they're like, it has an R squared of 0.95. But what if, Disney has an earnings announcement or the correlation changes and suddenly they, are on the hook for some serious losses, and then they have to degross their entire book, and so they reduce their positions massively across the board. To what degree, when we see, oh my God, this stock's up 10% or this sector ETF is down 4%. To what degree is that due to sort of the long short players? Like, because I think they run a pretty big line, right?
Yeah, it's a great question. So I do think that their positioning does have an impact on markets, especially in this environment. So I mentioned we were just talking to this technical strategist, and these surveys are widely available now. So this is not like anything that's super surprising. But hedge funds have been kind of in risk off mode, to your point, for a while now. What hasn't happened is actually retail has actually been buying dip this whole time, but hedge funds have been degrossing and in risk off mode since kind of some since late last year, some earlier this year, and I do think it affects markets. But I think to answer your question in a different way, I think that my personal view on long short is there's a structural kind of pre-financial crisis, and this is when I first started in the hedge fund industry, sitting inside prime brokerage at Goldman, which provided the both the leverage and the short availability to long short funds. So I'm fairly familiar with how structurally how everything works. So I think there was a structural advantage to long short funds pre-financial crisis because interest rates were above zero, which they're going back to now. And so you got paid, so let's say you ran 60-40. So you ran 60 long, 40 short. So you had 40 cash. You had a gross exposure of 100%, net exposure of 20%, right? So on your 40 cash, you were receiving interest minus whatever prime brokerage takes as their cut. On your short balance, one of the things that I think people is lost on people is that there used to be a short rebate. So whatever you would get paid a short rebate on your short. So on that 40%, you would get paid some percentage also minus whatever the banks take. And so combine that with whatever beta you have in your portfolio, you were structurally creating a decent return. And if you were to add some alpha, right? If you were actually making alpha on the long and short side, you were getting into double-digit kind of net returns for investors while taking less risk. And so I think it was a structural issue that helped a lot of funds, and that's what helped maybe the lower quality funds not be as evident than they would be otherwise. I think what's happened since the financial crisis, because interest rates have been at or near zero since then, is that interest element and that rebate element went away. In fact, on the short side, you now have to pay to short stocks, and that's made that kind of like turned that structural element upside down, right? And so that's made performance for long short funds challenging. And I think that we're if I were to make a call, bullish or bearish on the hedge fund industry, I think we're back to kind of a bullish environment for the hedge fund industry, particularly long short, because interest rates are going higher, at least for the foreseeable future, and stock picking is probably going to be more relevant than it has been in the prior decade or so, because you have this turn in. I think what we're seeing is, we've seen this massive move to passive investing over the last decade, because that's what's been working. And it's because we've had this liquidity just driving asset prices higher. We've seen a turn. And so I think that that's going to create opportunities for stock picking. And I think that it's going to set it up for long short managers to actually generate some decent performance and outperformance.
What do you think about private equity and venture capital? Does Centerfin allocate to them?
So not currently, and it's not. I wouldn't say never, but it's not in the current even pipeline or kind of roadmap for us. The reason is, I think, again, my personal view on private equity is just levered equity, right? What do most private equity managers do? They buy a company, they take it private. They put a bunch of debt on it, and then they hope that they get an exit on their equity that's higher than what they paid for it. And so I think that, again, that worked really well in the environment that we were living in. Not quite sure how it's going to work going forward, but I've always been kind of skeptical of the strategy. It's been very popular with institutions, and I think it's largely because performance has been good, but I think it's also largely because there's not as much mark to market as there is in public securities. And so, you're getting quarterly, performance numbers. You're not getting, weekly or monthly estimates or anything like that. And so I think institutions like not having that mark to market, and it's been, the environment's been very conducive to it. Venture, that's another one where, I think there's been a lot of money raised in venture, and I think it's, it's supported, a lot more startups than would have been viable in a different market regime. And so, I think there'll be books written on this later, but I do think at a very high level, all of the capital that was kind of pushed into the system, kind of post-financial crisis and post-COVID, created an incentive structure that caused for bad asset allocation decisions to be made, both on the investing level from professional investors, retail investors, and at the company level, right? And so companies, using cheap debt to lever up their, to use that as financing. Some companies may be able to support it, some companies may not, right? And so I think we're gonna see a washout of this, and so I think for us, we'd rather wait and see how this all plays out before we make any big decisions that way.
Right, and just for our audience, when Kyrill said private equity funds don't have as much mark to market, what he's saying is that in a stock or ETF, you can every single second you can see exactly where it's trading. The market is telling you what it is valuing at. At private equity, you only get that quarterly, and because there isn't no market, it's essentially made up. I mean, I'm not saying that they're like making the numbers up, but the public markets have to deal with volatility, that the private markets do not. Let's just put it like that.
Correct. Yeah, and institutional investors they prefer that, right? Because who likes to see during COVID crashing 35% in 6 weeks? Nobody likes to see that kind of drawdown.
Kyrill, what would you say are the most common behavioral mistakes that investors make? I guess we can do institutional, but also in particular retail. And to what degree do you think Centerfin is playing a role in trying to help people avoid those behaviors?
Yeah, great question. I think in my experience dealing with institutional investors for my whole career, almost 20 years of kind of interfacing with institutional investors, I think, my conclusion has been that, they are prone to the same behaviors as retail investors, right? So they're humans, right? It's not a knock at all. These are human beings that are in these roles of allocating capital to either directly into the markets or to managers to manage on their behalf, and at least to speak to managers and manager selection, manager allocation, asset allocation. What I've experienced with institutional investors has been a lot of the same kind of biases as retail investors. So there's a lot of performance chasing. There's a lot of groupthink, right? So institutional investors like to get together and they talk about, which fund manager they like and who's been, performing well for them and who's not. And that tends to kind of drive their behavior. Now, not to say that there's not like super high quality asset allocators out there. There are, but I think that some of those biases that are typically really, associated with retail investors exist with institutional investors as well. And the other thing I'd say is that I think right now is very important to point out that there's recency bias. And so we were talking about before, the Fed put and buying the dip. I think that there's that's kind of, again, I think that's across the board, permeating the institutional and retail investor universe. And as we talked about before, the hedge funds have gone kind of risk off and defensive. The retail investors have yet to do so. And we have this debate internally whether or not the retail investors will be the last to capitulate. And our CIO, I think, has maybe a contrarian view where he thinks the retail investors actually have a much longer time horizon, which is true because they're not beholden to they're only beholden to themselves. They're not beholden to any other stakeholders. And I think my view is if you look at history as a guide, the retail investors eventually capitulate also. And so and that may be that may be you were asking about signs, but if we stop seeing that buy the dip behavior from retail investors in the kind of near to medium term future here, that might be the sign of a bottom.
So what are you doing at Centerfin? Are you buying the dip? I guess the opposite of that is shorting the rally, or are you somewhere in between?
We're not buying the dip, nor are we shorting the rally. Again, I think we need to balance. We have to take a step back every time we have these discussions and think about the time horizon that we're working with, right? So we're working with 10, 20, 30-year time horizons. And so we have to balance our view of what to do tactically versus that long perspective. And so what that's meant is just tactically tweaking the portfolios as these markets have been developing. And that's an ongoing process. And that's why we think, we had talked about earlier, that what Centerfin is not categorically is a robo-advisor, because we think that having some sort of predetermined rules around rebalancing and asset allocation that don't dynamically change what's going on in the market, we think that's not going to lead to good results in this environment. And so I think that's something that needs to be actively monitored, and we have a very healthy dialogue around that pretty much on a hour by hour basis.
Mm-hmm. So obviously, I think it's very cool that you implement macroeconomic views into your investment portfolio. But let's just say hypothetically, what about a client who wants to buy the dip and says, "Hey, Kyrill, how come we haven't been buying the dip in my account? I want to buy the account." I mean, are you just going to tell them what you think about the Fed and the recession, or are you going to say, "Okay, fine, we'll buy the dip for you"? Like, also, do you do separately managed accounts?
So all of our accounts are held at a broker dealer custodian, and so and we're the investment manager of them. So that's how it's structured. And I think that our goal would be that that we can help our clients kind of see the point of view. Obviously, like, it's the client's money, and so we're kind of beholden to them to do what they want to do. But I think that, at least in our experience thus far, I think that we've been able to explain to folks how we're positioned, why we're doing what we're doing. We put this all, out there. So, it's all out there. We have, we've published our views publicly. So, people can go back and read and grade us. And we're never going to be 100% right. But I think, the decisions we make are thoughtful based on, everything that we're experiencing and observing. And I think that, thus far anyway, our clients have been very happy to kind of let us help steer.
And what's your view on crypto?
That's the $1 million question. So we talked about this a little bit offline, but behind me is actually a copy of the Bitcoin white paper. So clearly, I'm a buyer of the space and a believer in the space. But I think I need to make it clear that I think crypto became, and I think it's all a function of the same thing, which was this very easy monetary environment that provide liquidity into risk assets and speculative assets, and crypto is kind of probably at the top end of that of that speculative ladder. But I do think that Bitcoin as a concept makes sense to me, and the reason is that Bitcoin has this very unique property in that it is money or value that has no intermediary, right? So if you have no matter how much money you have, if you have it at the bank, it's at the bank. It's not your money. The bank is holding it for you. Bitcoin is super unique in that, if you hold it in your private wallet with your private keys in a cold wallet, nobody, unless they physically take it from you, nobody can take that Bitcoin, right? And so my view is really informed by, I grew up in the Soviet Union. We left there as refugees in the late 80s. We were not allowed to bring anything with us. So, we didn't have any wealth, but, we weren't allowed to bring anything out of the country, right? And so if you kind of take a step back and you think about what's going on in the world right now, is there a need for a sovereign-less money, right? Like a money that's not tied to any country or any government? I think there is, and I think that's the use case. And I think that crypto kind of built on that, and it gets caught up in these like narratives and boom and bust cycles and whatnot. But at the end of the day, I think Bitcoin to me makes sense, and I think Bitcoin will continue to be around. And I think that Bitcoin belongs in client portfolios, or some small exposure to crypto belongs in client portfolios, but it needs to be sized accordingly because it's super volatile and it's super early in its life. And so that's what we recommend. That's what I've been recommending, even before Centerfin, to friends and family, is 1 to 3% of exposure into the space. Some people have listened to me, some people have not listened to me, some people have a lot more exposure, and that felt great until very recently. So I think that there's something in Bitcoin. I believe in that. I do believe there's some stuff going on in crypto that is also very, very interesting, and we follow. And are fairly educated on it, but I think that it's still early, and so we need to see, how things kind of turn out before we make any decisions as it pertains to clients.
So, do you currently invest clients' fund in crypto or no?
So we have a small allocation. We actually have just a 1% allocation to currently an ETF that is highly correlated to crypto. This wasn't available even 12 months ago, but there's been, if you follow, I'm sure there's been a bunch of products that have been launched that kind of give exposure, and that we think is the appropriate exposure today for clients in the space, because you have the kind of added benefit of these are publicly traded companies and publicly traded ETFs. So there's a little bit of protection against some of the negative elements of crypto that I'm sure you hear about all the time. But yes, we do.
Okay, so this ETF owns crypto companies, not crypto itself.
Correct. Yeah. So similar to kind of our discussion on commodities and commodity equities. There are now crypto equities. There's now enough of them that you can have a diversified basket of companies that are highly correlated to what's going on in crypto, and we think that at this stage that's appropriate in a small way.
And that preference, that choosing the crypto companies over cryptocurrency, digital assets, is that a preference that you're making that's purely from an analytical sense, or is it a regulatory thing, like you want to own crypto but you just can't because of the law?
It's no longer, I think, a regulatory thing, but I do think it's more complex and there's certain companies that have made some strides, as I'm sure you're aware of, in allowing for RIAs to own crypto directly for clients. And it's not it's definitely something on our roadmap, but at this stage we think that that's it's not by any means an analytical decision. It's more of a kind of structural decision, I would say.
That makes sense. Do you have, and of course, everything that we say in this podcast is not investment advice. Do you have a single company in crypto that you're just wildly bullish on that you think is super undervalued at this current stage?
I really wouldn't say so. I think a lot of these companies still, I think the space is still early. And so I think that, you've seen massive drawdowns as I'm sure you're familiar with. And some of these stocks might look cheap, at a very high level, but I do think that there's still going to be disruption to some of their business models. I will say, on a personal level, not investment advice, but I'm a fan of Jack Dorsey. I think he's a really interesting thinker, and I think I'm following kind of what he's doing because I think he's kind of stepping off the board of Twitter, and focusing on. I think it's called The Block now instead of Square. But I think that, it's worth following what Jack Dorsey's doing, because I think he's a very thoughtful, thinker in this space. Interesting.
Kyrill, my final section of questioning for you would be about that basket of alternatives that is called macro hedge fund. So I've interviewed macro hedge fund managers, have a lot of macro analysts on here. But when you are allocating to macro hedge funds, how do you sort of think about that risk reward? And are you betting that the manager is good? Are you betting that the portfolio manager is an efficient trader? Are you betting that their macroeconomic view is right? If so, does that just play into your macroeconomic bias as a deflationist and inflationist? And then, how does it sort of the return stream fit within the sort of panoply of assets?
Yeah, so currently we do not have a macro manager exposure for clients. We do actively speak to very smart macro managers on a regular basis, and that kind of helps inform our macro views and how we think about asset allocation. But I think global macro is one of these strategies. And to take a step back, I think global macro is one of the earliest hedge fund strategies when the hedge fund industry was still very, very nascent in the 1970s, I think 1960s or 70s. A lot of the managers that kind of emerged at that point, and these are like legendary names like Druckenmiller and Soros and Paul Tudor Jones and Louis Bacon. The basis of how they invested, I think, almost always came down to global macro, and what that means is why it's hard to define is because that basically gave them free reign to do whatever they wanted across different asset classes and geographies, with the one kind of common theme that all of these views were implemented from a top-down perspective instead of bottoms-up perspective. So instead of looking individual at a company, a Coke versus Pepsi example, they're really looking high level, and they're saying, are U.S. stocks, expensive relative to European stocks or Japanese stocks, or are interest rates in the U.S. Rich relative to yields in Japan or the Eurozone. So they're making, they're analyzing things at a very macro level, and then they're positioning their funds to take advantage of those views. And so I think, as we progress here, and as we talk to more and more managers and potentially include them in the portfolios, it'll be the same exact thing as with any other manager. It's, first of all, do we know the manager? Do we know them well? What does their process look like? Because, the other thing that I think is interesting that I think you and I touched on offline is, macro is not a really good strategy kind of post-financial crisis, similar to long short equity. And I think it's because we just had this kind of one-way monetary policy globally, right? It was just, an easy monetary policy. And so it's very hard when there's not a lot of changes going on as a macro manager to consistently make money, right? You either, your best thing would have been to just buy risk assets and just, hold on and buy the dip every time, like we talked about. But the truth is that nobody's paying that manager to do that. They can do that themselves. I think, I remember, very distinctly our CIO, K2, and I, in March of 2020, when COVID first hit, we were talking and kind of discussing the world and, is the world ending or what's going to happen here? And one of the, things that we had high conviction on is that, macro as a strategy probably will become a much more viable strategy going forward, because again, a regime, not to beat a dead horse, but I think we're in a regime shift in markets because, monetary policy has shifted from, easy to tight. And rates are going higher globally, except for places like Japan where they're trying to hold them down. And I think these are all things that are worth paying attention to, because it's going to create opportunities, not for us, but for those managers. And hopefully we'll find the managers we will want to work with to capitalize on some of those big moves.
So you'd be open to working with macro managers down the line?
Correct. Absolutely. We think it's a super interesting, viable strategy in the current market environment.
Kyrill, so you had a view a year ago about inflation, and that's relatively easy to tweak inflation within the sort of 60-40 portfolio. You just sell all the bonds. But what if you have a little bit more like nuanced or harder to implement thing, like you think that the strength in the dollar is going to dissipate and that the euro is going to strengthen? How would you implement that macro view?
Yeah, so we were literally just talking about this morning. The dollar has been, kind of a rocket ship. If you look at the, if you look at the chart, it looks like a tech stock from 2 years ago, and that has ramifications, right? That has ramifications fundamentally on companies. So U.S. multinational companies that derive, some percentage of their revenue from outside the U.S. That's going to put pressure on that part of their business. It also has ramifications on, the prices of commodities, and has ramifications on, other countries globally. And so I think we were discussing, from a technical perspective, and again, this seems to be, I'm hearing more and more of this, so it seems like it's becoming consensus. But if you look at DXY, it's trading at 108, which looks really high on a short-term chart. But if you pull up a longer-term chart, it made a high of 120 back in 2002, and from a technical perspective, there's no reason why it can't go that high. That would be potentially really interesting if that were to happen, but it seems like the more likely thing is that that strength should abate in the coming months, and I think that that's just going to be I don't think there's anything to do about that, except for the fact that that's going to be bullish for commodities, and we already have a decent amount of exposure there, and so I think that's actually we think one of the things that's been part of what's been holding or the recent weakness in commodities has been due to this dollar kind of crazy dollar strength that we've witnessed.
And then how are you thinking about emerging market countries or really any non-US markets? So Europe, China, and all sorts of other countries' stocks.
Yeah, no, it's a very active internal discussion. Generally speaking, we've been bullish on emerging markets, but obviously emerging markets, have this headwind of the dollar that we've experienced. Emerging markets are also, there's decent correlation between commodities and emerging markets, so it's kind of similar realm. And China is the biggest emerging market, and it's worth following what's going on in China, and we have been very closely because, we think China, and this is again I don't think it's super insightful, but China has clearly changed their stance towards the Western world, where I think that for the last couple of decades they've been very kind of friendly, wanting to engage and be in business with the U.S. and other Western countries. It seems like they're now moving to be much more focused internally, and really focused on what's good for China, and not really as friendly to the Western world. And so that's going to determine, I think, how the situation in China evolves is going to determine I think our views on, broadly speaking, emerging markets, because it's the largest of the emerging markets. I think Europe is potentially that's actually one exposure we've considered getting out of for clients recently, because we think Europe's potentially in a tougher place because they're facing the same kind of recessionary pressures that the U.S. is facing, but they have the additional problem in that the ECB has been even so they have inflation, they have recessionary fears, but the ECB has yet to really change their kind of stance, and so there's a higher probability of things breaking there, and you're seeing that a little bit in terms of the fragmentation of government securities yields in the various different countries in Europe, and that's something worth following. But that's one place that maybe if you nothing seems obvious at the moment. It's a very a very tough environment, but if I had to choose a place that seems where we can take some action right now, it would be to just kind of get out of European equities at this point.
Interesting. Well, Kyrill, it's been great having you on Forward Guidance. Where can people find you? Do you have Twitter?
I'm on Twitter. I've been trying to get more active there. My handle is Wall Street Hobbs. It's WALLSTHOBBES. And obviously Centerfin.co. I'm Kyrill at Centerfin.co. And happy to engage with people. Always happy to chat and have a dialogue.
Wonderful. Thanks so much.
Pleasure. Thank you for having me on, Jack.
There is something that you need to be doing right now, and that is reading the Blockworks Daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks Daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.